Hey everybody, Tim Ulbrich here, and welcome to this week's episode of the YFP Podcast, where we strive to inspire and encourage you on your path towards achieving financial freedom. This week, I'm going to be providing an update on the major changes that we have to student loans and student loan repayment as a result of the passage of the Big Beautiful Bill. Now, we're not going to focus much, really at all, on the implications for new borrowers, and those are significant. So for those of you that are listening, and perhaps you've got children that are getting ready to enter into college, this is worth digging deeper. But on this episode, I want to focus on changes that are going to impact those that are in school, but those that are also out in active repayment. So again, lots of changes as a result of this bill. We'll talk about what those changes are and the implications that they may have to your individual situation. Now, as it relates to your individual situation, right, everyone listening has a different situation. So this information is meant to be informational. It's meant to be educational. I would highly encourage you to consult with a student loan professional, such as the certified financial planners on our team at YFP that do this work for a living, as you look at how these changes are going to be implemented and applied in your specific circumstances. Yes, as it relates to the student loans, but if you've been listening to this show for some time, you know that not any part of the financial plan is one that we should look at in a silo. So as you're determining how to optimize your strategy to pay off six figures or more of student loan debt, we of course want to be looking broader across the entirety of the financial plan. And so as always, if you're interested in learning more about our fee-only comprehensive financial planning services to address not only the student loans, but the broader financial plan, we work with pharmacists all the way from those that are entering retirement to those that are just getting started. You can head on over to yourfinancialpharmacist.com and you'll see an option there to book a discovery call. Now, before I get too far, for those of you that are listening to this episode, we're going to get into the weeds on several things. And so for that reason, I have some visuals that I'm sharing along with the recording. So when we get into the details on how the income-driven repayment calculations work and comparing one plan to the next, including the new plans that we have coming out, visuals I think are really helpful for this, as it can get quite technical and overwhelming pretty quickly. And so if you want to watch, whether it be now or catch this episode later, make sure to head on over to our YouTube channel and you can watch this episode and see the slides that I'm sharing along the way as well. All right, let's jump in. Let's jump right in. So, how did we get here? How do we get to this point of student loans really being a hot mess, if we're honest, chaotic to say the least? Student loan history goes back some time, but I want to really draw our attention to the changes that we see since March of 2020. Okay, so at March of 2020, at that point, we obviously all began to bunker down for the pandemic. And you might remember there was a stimulus bill that was passed, a significant stimulus bill. And as a part of those legislative efforts, there was a freeze, an administrative forbearance that was put on federal student loan repayments. That's the focus of this discussion today, federal student loan repayments. And again, as I mentioned to begin with, yes, there's significant changes that have happened for those that are going to be entering school, but I'm going to focus most of our time today on those that are in active repayment or entering into active repayment and what those changes are. So in March of 2020, our federal student loans were essentially frozen. So $0 interest. So for those that were in active repayment, not only did they not have to make payments, but they also had a freeze on the interest. That was a pretty good deal. And a better deal for those that were pursuing public service loan forgiveness, they were getting qualifying credits without having to make payments and without seeing their interest balance grow. For those that were in school during that time period, what we saw is that for most pharmacy students who are accruing unsubsidized loans, meaning that the federal government is not subsidizing or not paying for the interest on the loans while you're in school, those loans essentially looked like a subsidized loan because the interest was frozen. Now, you might not have felt that because we typically don't feel student loans while we're in school, but that certainly was a benefit of that freeze period. Now, that started in March 2020. It was extended by the Trump administration, again by the Biden administration. We had several extensions of that all the way to June of 2023 when Congress said, hey, no more. We're going to end the payment pause extensions. We're going to end the interest freeze. Now, what we then saw happen next in June of 2023 is the Biden-Harris administration came out with a proposal to cancel up to $20,000 of debt for certain borrowers, depending on loan types, depending on income requirements. For many, it was probably going to be $10,000, but it could have been up to $20,000. That got challenged all the way to the Supreme Court, up to the Supreme Court in June 2023, and they issued a decision that was not going to happen. They felt like it was an overreach of the executive branch of the federal government. So as a result of that, as a result of the debt cancellation not being allowed to move forward, the Biden-Harris administration came out with a new income-driven repayment plan called the SAVE plan. Many of you are probably familiar with this plan at this time because there's been a lot of attention around this plan. And the SAVE plan, in my opinion, was the Biden administration attempt to come out with the most favorable income-driven repayment plan that they could, and to get as close as they could to maximizing the benefits to borrowers, knowing that the debt cancellation wasn't going to move forward as it had just gotten struck down by the Supreme Court. So the SAVE plan, I'm going to talk in a little bit about how the calculations work on these plans to come up with your monthly payment. But essentially, the SAVE plan was going to be very favorable, more favorable than the income-driven repayment plans that we had available until then. Now, if that term is new to you, income-driven repayment plan, or IDR, simply put, it's a calculation that determines your monthly payment, as the name suggests, by your income. So the income is the driver, right? Income-driven repayment plan. The income is the driver of your monthly payment. Not your loan balance, but your income. And specifically, it's your adjusted gross income that's used in that formula. Now, if adjusted gross income, known as AGI, is a new term, so when you go to file your tax return, you'll notice that at some point you get to your AGI. So it's your gross income minus what's called the above the line deductions. Okay, so these are things like if you make contributions to your traditional employer retirement account, like a 401k or 403b, this would be things like student loan interest deductions. This would also include HSA contributions. Those are the most common ones. So for example, if I make $120,000 per year and I contribute, let's say $20,000 to a traditional 401k, my adjusted gross income is not 120, but it's 120 minus the 20 that I contributed to the 401k, traditional being the key word there, which means that my adjusted gross income would be $100,000. Okay, so that adjusted gross income term, I'm deviating here for a moment, but it's important and relevant as we get into the weeds on how these calculations work. So the SAVE plan modified that formula that uses adjusted gross income so that it was going to be more favorable essentially than other plans that we had available to us. And it had some other benefits as well, but not going to spend too much time on that because highly unlikely we're going to ever see the SAVE plan come back again. Now, that was August 2023 that the Biden administration issued the SAVE plan. Now, fast forward to February 2025, there was a federal court injunction that prevented the Department of Education from implementing the SAVE plan. So essentially, the SAVE plan was legally challenged. And long story short, the reason it was legally challenged, politics aside, is how the SAVE plan was crafted. So the mechanisms that were used to create the SAVE plan and other components of income-driven repayment plans is different than the legislative scope and work that was done to create some of the older plans like the IBR or the income-based repayment. So because of that, we can simplify this a bit to assume that legislatively the SAVE plan, because of the pathway that it was used to create, wasn't as safe or secure as other components of plans such as IBR, which is an income-based repayment plan. Okay, so that was February 2025. We had a federal court injunction preventing the Department of Education from implementing the SAVE plan. A month later, in March of 2025, the Trump administration issued an executive order titled Restoring Public Service Loan Forgiveness. Restoring Public Service Loan Forgiveness. Now, the reason I bring this up, it's an executive order, so it doesn't have legal authority, or excuse me, what I should say is it's likely to be legally challenged if it were to be implemented. But essentially, the point of the executive order is to warn institutions, specifically institutions that have nonprofit status that are PSLF eligible, that if they aren't adhering to certain alignment with the Trump administration policies and so forth, that their 501c3, their nonprofit status may be at risk. Okay, so you can obviously understand the significant implications of what this would be. And I think time will tell us in terms of how this is going to play out and obviously the politics that are behind it. Most recently, if we keep going down the timeline, getting to current state, in July of 2025, we saw the passage of the big, beautiful bill. It worked its way through the House. That kind of brought the alarm bells of, hey, there's a lot of changes that are likely going to be happening to student loans. A lot of experts that I follow on this topic kind of thought that, hey, some of this might get watered down or changed in the Senate, and some of it did, but I don't think as much as we maybe thought it would have. And so ultimately that big, beautiful bill got passed, and we're now dealt with the implications and understanding what those are. That's the focus of what we're talking about here today. Now, at a high level, what is the impact of the big, beautiful bill on student loans? And again, I want to zoom out here for a moment, not the focus of this episode, but the big, beautiful bill has impact not only on student loans for those that are in active repayment, our focus today, but also, as I mentioned, for those that are future borrowers or parents of future borrowers, big implications, but also the big, beautiful bill. Student loans were just one part of that. So we'll be providing some more information and resources coming down the pike and how you can be thinking about this from an implementation standpoint, not just for student loans, but other components of the big, beautiful bill as well. So what were the student loan impacts specifically for those that are in active repayment under the big, beautiful bill? Well, first of all, it's going to phase out no later than July 2028. Okay, it could be as soon as July 2026, but no later than 2028. Where will it be in there? Time will tell. Obviously, it will depend on how aggressive the Department of Education, how aggressive the administration wants the Department of Education to be on implementing this. But there will be a phase out no later than July of 2028 of current income-driven repayment plans, including the SAVE plan, the ICR plan, and the PAYE, the pay plan or the pay as you earn. So the SAVE plan, the ICR, and the SAVE plan are going to go away. And the big news here is that that is not only in terms of future borrowers is going away or future people that are entering into active repayment, but it's impacting those that are in active repayment today. Now, why is that significant? Well, it's significant not only because of the implications it has, but also because all previous changes or the last decade or so that I've been doing this work that were proposed as it relates to student loans were always focused on grandfathering those that were in active repayment and impacting future borrowers. That was, I think, some of the headline news here with this bill is that it's going to have impact on those that are in active repayment. Okay, so we're going to see a phase out no later than July 2028 on the current income-driven repayment plan, specifically the SAVE plan, the ICR plan, and the pay plan. It also establishes a new IDR plan called RAP, or Repayment Assistance Plan. And we'll talk about what that is here in a moment. There's elimination of the partial financial hardship to enroll in IBR, and there's a significant impact coming for those that are Parent Plus borrowers. Now, a note I want to make about the timeline. Okay, so I mentioned that the specifically the ICR and the pay plan are going to transition to IBR, income-based repayment, or RAP, okay, sometime between 2026, 2028. I mentioned no later than 2028, but it might be as soon as July 2026. Now, for those that are in the SAVE plan, I'm going to reiterate this here in a moment. We just learned this past week, there was a press release that came out from the Department of Education that the SAVE interest component, the freeze that's been there for those that are in the SAVE administration forbearance, that's going away effective August 2025. Now, as I understand it, people can still stay in the SAVE plan while that's being litigated until that litigation is finalized, or until 2026 comes when they're going to be forced to enter into a different repayment plan. Again, somewhere between 2026 and 2028. Okay, let's keep moving along with other changes. So if we think about the big, beautiful bill's impact on student loans before and after, on the repayment plans that are available, right? Before the implementation, and when I say before the implementation, I'm really referring to July of 2026. Okay, before this, we had a host of repayment plans that were available to borrowers. You had the standard 10-year repayment plan, which is a fixed monthly payment every month for 120 payments or 10 years. We had the graduated and extended repayment plans that allowed us to take those out longer. And then we had a host of what were known as those IDR, those income-driven repayment plans. Think of IDR as an umbrella term. Okay, it's a type, a category of repayment plans that, again, where your income is the driver of how much you're going to be paying off. Now, those plans that are under that umbrella were IBR, income-based repayment, ICR, income contingent repayment, pay-as-you-earn pay, and what used to be repay, which became the save plan, right? Couldn't be more confusing. Isn't it beautiful how simple this is? Now, one of the headlines coming out of the big, beautiful bill's impact on student loans is that once we see the implementation of this, they're going to be simplifying the number of plans that we have down to essentially 2 plans. And the headlines that you see out there is you're going to either be able to enroll in the WRAP plan, which is the new repayment plan, or go into the standard plan. Now, there are some changes that are happening to the standard plan where essentially, think about it as like a sliding scale. Essentially, as your debt load is higher, your repayment period or window goes out longer. And you can look up the tables and information on this to see what that repayment period would be. Now, while the headlines are kind of suggesting, hey, we're only going to have 2 repayment plans, that is true for future borrowers that are coming out. For those that are in active repayment, if you're in an old income-driven repayment plan, right, which would be the SAVE plan, which would be the ICR plan, which would be the IBR plan, you will have IBR available to you come July 2026. So effectively then, the way I look at this is there's really going to be 3 options. There's going to be the new option, which is WRAP. There's going to be IBR for those that were in active repayment or entering into active repayment over the next year, right? So class of 2025, after the grace period ends. They're going to have the option, if you were in an income-driven repayment plan, you have the option to go into IBR, or you can choose that standard option that I just referred to. Okay, so what is the WRAP plan all about? The repayment assistance plan. This is the new repayment plan that's going to be one of the few options that we have available. Well, you cannot enroll until July of 2026. So if you're kind of itching for whatever reason to get into the WRAP plan, know that you can't do that right now. Okay, so July 1, 2026 is the enrollment date that's been put out there by the Department of Education. Now, what's different about the WRAP plan from the previous income-driven repayment plans, and I'm going to show visually what this looks like here in a moment, is that the monthly payment is based on a percentage of your adjusted gross income. Now, that might sound similar to the income-driven repayment plans, but it's different because the other plans would subtract from your adjusted gross income a percentage of the federal poverty level to calculate what's called your discretionary income. And again, I'm going to show this visually here in a moment. WRAP, what's different about this is it's just a percentage calculated directly off that adjusted gross income or that AGI. Now, the way they do it, it's a sliding scale. So the percentage of your adjusted gross income is 1 to 10% for people that have an adjusted gross income less than 100. Once you're over 100, it's going to be that 10%. Now, that will be most pharmacists, of course, but if someone's in training years, fellowship, residency, graduate school, whatever might be the case, then obviously that sliding scale would come into play. One of the benefits of the WRAP is that it's going to have interest subsidies if your payment does not meet the interest accrued. Well, what does that mean? Well, let's say that based on your calculations, because you have a very large debt load, let's say your interest is accruing at $500 a month, but your payment only requires $300 a month based on your calculation. Well, that difference, right? That difference, instead of accumulating and then eventually capitalizing, where it gets added to the principal and starts growing interest, there's going to be a subsidy that essentially that interest won't accumulate and get capitalized. Okay. There's also a $50 per month reduction per dependent. So based on dependents that you report on your tax return, you can do married filing separately. So for some people, and this if you've listened to the show, that might be a strategy. Might be is the key word, needs further analysis, especially for those that are looking at a public service loan forgiveness strategy. One of the downsides of the WRAP plan is that it has a 30-year repayment period, which means for those that are pursuing forgiveness, specifically non-public service loan forgiveness or IDR forgiveness, that's a 30-year pathway. For many pharmacists, depending on your debt load, depending on the income you make, there may not be anything left to be forgiven after 30. So if we look at some of the other income-driven repayment plans, that was 20 to 25 years for that non-PSLF forgiveness. One of the other downsides of the WRAP plan is once you're enrolled in WRAP, you're stuck. Okay, so with current income-driven repayment plans, you can switch between those. Once you're in WRAP, at least as I understand it at this point, you're stuck. And WRAP is PSLF eligible. Okay, so WRAP is PSLF eligible. So that's a brief overview of the WRAP plan. Now, if we look at IBR versus WRAP, and again, if you're listening, make sure to go out to the YouTube channel, check this out visually. I'm essentially showing the difference between old IBR, new IBR, and the RAP program. Okay, because I think many people listening are going to be choosing between IBR and RAP. Now, if you're not familiar with kind of old IBR, new IBR, this is based on when you took out loans. So if you took out loans prior to June of 2014, June 30th of 2014, you have old IBR. If you have loans that are after July 1st, 2014, it's new IBR. And then, of course, RAP would be for new loans that are dispersed. Now, there's some significant differences between these, and the table really highlights that and how this could have an impact on your repayment plan. How much your monthly payment is different between these. So I just explained with RAP, it's going to be 1 to 10% of your adjusted gross income, but it's going to be 10% for those that have $100,000 of income or higher. And then, as I mentioned, you would subtract from there that $50 per month per dependent. IBR old, it was 15% of discretionary income. So again, discretionary income, very different than just the direct AGI percentage. And with IBR new, it's 10% of discretionary income. So IBR new is more favorable in that sense. The interest subsidies are more favorable with RAP. So what I'm referring to again with interest subsidies would be is if your monthly payment amount doesn't meet what the interest accrual amount is there, there's help there. So that is applicable with RAP. For IBR new and old, that's only true for subsidized loans. The repayment period is different. So with RAP, as I mentioned, it's 30 years. With IBR new, it's 20 years. IBR old is 25 years. Why is that relevant? Well, if someone's pursuing non-public service loan forgiveness, obviously the shorter that timeline means the more likelihood that we have dollars to be forgiven. Are you able to switch repayment plans with IBR old and new? Yes. With RAP, no. And then tax filing status with all three, you could potentially employ a married filing separate status if that were to make sense. And certainly that needs further analysis. So I want to show you how the calculations work. This is just one example because I think this helps this topic really come to life. Okay, what I'm showing here is for IBR new, and we could apply this to IBR old. You could obviously do your calculations yourself. But remember, with IBR, your monthly payment is based off of discretionary income. And this is just an example. And your discretionary income is your adjusted gross income, right? I defined that before, which is your gross income, your top line income minus any of those above the line deductions, like traditional retirement contributions, HSA, student loan interest. So it's your adjusted gross income minus 150% of the federal poverty level. Okay, that amount is your discretionary income. That then gets multiplied by a percentage. So with IBR new, that would be 10%. With IBR old, that would be 15%. That divided by 12 months becomes your monthly payment. Now, looking at this same calculation, let's see how that differs for RAP. So remember, with the IBR, it was your discretionary income, right? Which was your adjusted gross income minus that poverty level indicator. That goes away with RAP. So there's no subtraction of 150% of the poverty level. It's just your AGI times 10%. So at face value, if you're not subtracting 150% of the poverty level, therefore it's just the AGI times 10% rather than the AGI minus 150% of the poverty level times 10%, right? At face value, the RAP monthly payment is going to be higher. Now, that's true when we look at new IBR compared to RAP. If you're on old IBR, because it's 15%, that may or may not be true depending on your specific situation, right, with your AGI. So these are kind of the nuances, but again, it's not just about the monthly payment. We also have to look at some of those other considerations, like the RAP does have the interest subsidy, but it also has a longer timeline to repayment. All things that we need to factor in when coming up with a decision that's unique to your situation. Now, if we apply some numbers to this, let's look at a calculation of IBR versus RAP. I'm going to use an income of $150,000. So if we take an adjusted gross income of $150,000 and we apply that to an IBR new calculation, $150,000 minus 150% of the poverty level, that number for someone who's single would be $23,475. If you're curious, you can look up the federal poverty level depending on number of dependents in your household, where you live. So this would be 150,000 times 23,475. That is discretionary income. You multiply that by 10%, you divide that by 12 months. In this example of IBR new for someone making $150,000, their monthly payment would be $1,054 per month. Now, I can't emphasize enough. Notice what is driving this monthly payment. It has nothing to do with the amount of student loan debt you have, right? Income-driven repayment, by definition, income is your driver. Higher the income you make, the larger your monthly payment's going to be. Now, what if we look at that same income, that same pharmacist on the WRAP plan, right? So remember, WRAP is just your AGI times that 10%. We don't get to subtract that federal poverty limit level. So if we look at that example, somebody who makes $150,000 and we multiply by 10%, that's $1,250. So instead of just over 1,000, right, with the new IBR, we're now looking at 1,250. So again, at face value, WRAP's going to be higher, but I'm comparing it here to new IBR. If you have old IBR, maybe not so much. And we also have to consider some of those other differences between the repayment plans. So the other thing I want to mention here that's really relevant is changes to Parent Plus loans. Changes to Parent Plus loans. So you might know if you have Parent Plus loans now, or you've already dealt with Parent Plus loans, there's been a pathway because Parent Plus loans aren't directly eligible for income-driven repayment plans. There's been a pathway where you can consolidate or sometimes double consolidate those loans to open up the pathway through the income-driven repayment plan and to potentially have those be eligible for something like public service loan forgiveness. Well, with the passage of the Big Beautiful Bill, if those Parent Plus loans are not consolidated by July 1 of 2026, they are ineligible for IDR plans and thus ineligible for forgiveness. So what's going to happen going forward is that it's going to default to the standard repayment plans for new Parent Plus loans for those that don't consolidate by July 2026. So we have this clock between now and July of next year, where if we have Parent Plus loans that have not yet been consolidated, and that's a strategy we want to pursue, that may be something that we want to consider and evaluate further. The other thing I want to mention is that just recently, actually July 9th of 2025, the Department of Education came out with a press release that announced that the SAVE interest pause was ending. Now, there's a lot of confusion out there around this. As I understand it, come August 1st of 2025, there is no longer going to be a freeze or pause on the interest accruing for those that are in the SAVE administrative forbearance. However, I understand that you can choose to remain to stay in the SAVE plan while it continues to be litigated, and then maybe perhaps you're forced out, or we get to that future date beginning July 2026, no later than 2028, where you're going to be forced to go out because the SAVE plan is going away. Now, whether you choose to stay or not is going to depend on a lot of factors, right? Right now, for those that are on the SAVE forbearance, sure, it's a great benefit. No payments, no interest accrual. However, if you're pursuing something like public service loan forgiveness, that's not counting towards your credits, right? Credits toward forgiveness. So it may make sense to switch repayment plans to be able to turn on those credits if that's a pathway you're pursuing. So again, that 0% interest subsidy is going away. Communication should be coming out soon if you haven't already received it. Now, I suspect that communication is going to be trying to push people into repayment plans, probably IBR, because that's going to be the one that's staying. But I believe you do have a choice to stay, although interest will be accruing. So you got to weigh that down. So again, what are the downsides to staying put? Well, interest is going to accrue and ultimately will capitalize. And again, no forgiveness credits, right? So what we learned from this press release is that borrowers in the SAVE plan will see their loan balance grow when interest starts accruing on August 1st. When the SAVE plan forbearance ends, borrowers will be responsible for making monthly payments that include any accrued interest as well as their principal amount. So stay tuned on this. I'm hoping we're going to get some clarification from the Department of Education about the option for people to stay in that plan, even if their interest is accruing. Now, when we put all this together, right, what is your student loan strategy? It depends. Well, what does it depend on? It depends on how much debt you have. It depends on how you feel about the debt. It depends on what your income is today versus in the future. It depends on what the budget can afford. It depends on if Parent Plus loans are involved or not. It depends on your tax filing status. It depends on whether or not you're pursuing forgiveness. And it depends on all the other things that are going on in the financial plan. So I cannot emphasize enough that how we look at our student loan repayment strategy in the midst of all these changes, in the context of the rest of the financial plan, is an incredibly important decision. And so if you're looking to consult someone to help you along that journey, again, we've got a team of certified financial planners. We don't do student loan consultations only. for all the reasons I just mentioned. But we do look at how it will apply to the broader financial plan. So for those that just graduated, I want to give a brief summary for two groups: those that just graduated here in 2025, and then those that are in active repayment, right? So pre-2025 graduates. Let's first start with the class of 2025. So for those that are class of 2025, you're kind of in this weird middle ground period, right? You're in the grace period in the moment. You're going to come out of the grace period into an old environment before the new changes take effect in July of 2026. So you will have the current menu of repayment options available except for the save plan, because they're not allowing new people to enroll in the save plan. But again, we got to know that changes are coming July 2026. So once the grace period concludes, you got to decide on deferment. And that might be beneficial that there's no payments, but may not be beneficial because you're going to see your loan balance grow because of unsubsidized interest occurring. So that's a decision we have to make. So you're going to have to decide on deferment if you can apply for deferment. So specifically thinking of like residents or fellows, or you're going to have to choose to enroll in a current plan, knowing that that might change come 2026. Again, come 2026, your option will be to stay on IBR for those that are on an income-driven payment plan. So for example, if you come out of the grace period and you choose the pay plan, you'll have an option to go into IBR. If you choose the IBR plan, you have an option to stay on IBR, or you're going to have an option to switch to that new repayment plan, which would be the WRAP, or as I mentioned, the third option, which will be the standard repayment plan. And then again, if you have Parent Plus loans, as I mentioned, that July 1, 2026 timeline for consolidation. Now, summary of the big, beautiful bill, impact on student loans for pre-2025 graduates. Well, if you're on the Save Forbearance, and I suspect we have a lot of people out there that are, again, interest is starting back up August 1, 2025, and you've got a decision to make, right? For those that are pursuing public service loan forgiveness, does it make sense to switch to a plan where you can start to get those credits counting towards that 120 for PSLF, or a longer timeline and credits for those that are on that 20 to 25 year forgiveness pathway under non-PSLF? So some decisions we have to make. And if you go from Save Forbearance into a plan that will not be around, then we're going to have to make another change come July 2026. Again, we'll have that option for WRAP come July 1, 2026. And same as I said for the class of 2024, if you have a Parent Plus loan, we've got that consolidation timeline that we need to consider. Last thing I want to mention is that studentaid.gov has to be bookmarked here over the next year. So much is changing. It's changing quickly. And to their credit, they've done a pretty good job of updating that information and explaining it in a way that's easy to understand. They've clarified things, FAQs, resources that are out there as well. So that really is the go-to source for information, changes, and updates that will be coming over the next year. Well, that's all I have for this week's episode of the YFP podcast. As always, thank you so much for taking time to listen to the show. If you like what you heard, do us a favor, leave us a rating and review on Apple Podcasts or wherever you listen to the show, which will help others find the YFP podcast.